Thank you for watching our Supercharging a Whole Life Policy into a Private Family Bank. First, let's understand how life insurance works. Here's a good way to start understanding life insurance. Think of the premium paid as two parts. One portion is going to the death benefit for your heirs, and another is going to cash value. The more premium that is going to death benefit depends on your age and health, of course, and then less goes into the cash value. Well, which part is more important to banking? Cash value, of course, because we're talking about building your money pool. Here at Private Family Banking, we use different techniques than a typical agent uses. It's not that their way is wrong, it just doesn't meet our objectives. The best way to work when you are building something is to keep in mind what your goal is. The goal is to maximize the cash value used for banking, unless our client asks us to work differently. The goal is to get all the tax advantages allowed without going into what the IRS calls a MEC. We'll talk more about that later since it's really important. Well, let's understand how the three major kinds of policies work. As an example, let's compare three kinds of policies, each paying in premium $5,000 annually for 4 years. The first is a term policy, and as it is graphed out, you'll see that it's a flat line, as there is only a death benefit, no cash accumulation at all. Next, there is a typical whole life policy. This type doesn't accumulate cash value for the first several years, which is actually not conducive to banking right away. It will take off eventually, and it does have all the great guarantees that you want. But now, those of us wanting to get all the tax advantages right away and want the great growth immediately will structure our policies to be supercharged right away. Graphing so you can see the terrific accumulation right from the beginning, we are allowing the optimized private family banking cash to grow more quickly, giving as much as 40% more than the typical whole life policy. And as you can see, that's due to that eighth wonder of the world, compound interest. The PFB policy has similar components with the typical whole life, but there are other components as well. Now, this graph is an automated showing of how the same premium dollars can be differently allocated in each policy. Our graph here flows right to left, with no cash value on the right and moving to an increase in the cash value. Along this line, you will have lesser death benefit, as we shall see. Now, if I allocated 100% of my premium to a death benefit, I'll have a term policy, thus giving me the maximum death benefit and no cash value. Clear on the other side of our graph, a big single premium can be put into a policy which will buy the insured a minimum death benefit, yet the maximum in cash value. So, you can see that on the right, this side allocates 100% to death benefit, the left side has minimum death benefit. Back on the right, no cash value, and on the left, max cash value. Now, there's a downside to single premium policies. Back in 1988, the IRS drew a line in the sand, saying this is just too good a deal. We're not getting any taxes off the people, and we don't like that. So any policy that accumulates too much value with too small of a death benefit will become a MEC, a modified endowment contract. Let's continue with our learning about life insurance policies. On the right side, after term, which has no cash value, we put the ordinary or whole life policy. This is the typical agent's go-to, but you have seen that it takes several years to build any cash. Moving toward more cash is the life paid up at 65. Since this policy must be self-sustaining in your older years, it will build cash even faster for you. Next, there is the 20 paid life policy. You can assume correctly that this type will build cash even faster. Of course, you also know that each of these policies will have a lesser death benefit. Allocations in any of these policies will be geared less to the death benefit and more toward growing cash. Yet, even these are not as beneficial to your banking. So let's see how to supercharge your policy. While there may be a place for a MEC policy, your focus should be toward the cash and the tax advantages. That's why we build your policy as close to the MEC line as possible without crossing it. Say hello to your private family banking policy. Tell me again, why do I want to make a banking policy for myself? To keep all that interest that you and everyone are currently paying to outsiders and financial institutions. Everyone is used to paying interest on the mortgages, credit cards, and your cars. Yet now you are the banker. With your banking policy, your premiums and profit grow your money pool, tax-free, so that you can float your own loans and pay yourself back for all the things that you live for. Again, you're doing it income tax free. So please look me up on our website, privatefamilybanking.com. Sandy Henderson, Chartered Retirement Plan Specialist. I'd like to show you how this private family banking policy can work for you to get you all the tax advantages and the tax-free growth possible for you and your heirs. You can call or text anytime. I'll be proud to talk with you. Thank you. Bye for now.